Good afternoon, everyone, and thanks for joining us here. It is just a couple minutes after 12, and wanted to give everyone a chance to get on. We have about half the people who signed up right now, so we're going to give it just another minute or two to get started, and I will be right back with you. Awesome. Well, in the interest of everyone's time, we're going to get started. So thanks everyone for joining us here today for our August webinar on the psychology of investing. For those of you who may not know me, my name is Dave Clayman. I'm co-founder and CEO of 12 Points, and we are very grateful to be joined today by Mark Peterson. Mark is the Director of Investment Strategy and Education for BlackRock and has spent 30 years in the industry. So he trusts me. He has assured me that he knows everything there is to know about the psychology of investing, and he's going to fire away. But in all seriousness, we are here for any questions you have as well as the presentation. So feel free to put them in the chat box, and we will get to them when Mark is done with his standard presentation. But we are ready to roll. So Mark, with that, I will let you take it away.
Great, thanks, Dave. Good morning, everybody. Thanks for hopping on the call today to talk a little bit about the psychology of investing, one of the topics that's near and dear to our hearts, something that's timely given everything we've gone through here the last couple of years, but timeless, meaning that it's always important when you're investing. It's amazing, and you'll see it throughout the presentation, how many quotes from great investors really have to do with the psychology or mentality that you need to have to be a great investor. So that's what we'll do the rest of the way here. Dave knows I'm a chart and graph guy, so I didn't leave many in the bag. So bear with me as we walk through these. And we won't hit them all just for the sake of time, but we'll start off with what is the key to investment success. I think a lot of people think of the middle of this pyramid. They think about what they actually own, right? You think about your portfolio, what kind of securities do you own? That's what makes a successful investment plan. But we'd argue that it actually starts at the very bottom, what we call investor behavior, and that's your ability to stick with the plan. You think about it, if you don't have that willpower to stick with your investment plan, if the market gets really volatile and you have some losses and you get out of the market, it doesn't matter how good of a portfolio Dave and team have built for you, everything else falls apart because you're on the sidelines and you miss those gains. So that's why investor behavior, that's why this topic is so critical. It's the foundation to any good sound financial plan out there, is to make sure that investor behavior it remains in check. And that's what we'll touch on through the remainder of the presentation. Stepping ahead, if we look at just an example of what is the psychology of investing, that's what this slide looks at. And this works a little bit better in person than it does virtually online because I can't see all your faces and your hands. But the question is, which investment would you pick if you looked at these four choices, these four lines? Which one would you pick going forward? So if all you knew about the investments was what you see on the page here, which one would you choose as your investment choice if you could only pick one going forward? And I can tell you, everybody think in their own mind, what would you pick here? Would you pick that red that's pretty volatile, the pink or purple, I guess, that is pretty steady, but actually finishes number 2? The green is number 3, and yellow, nobody ever picks yellow, by the way, so I shouldn't even throw it out there. Yeah, Dave's taking the contrarian plan, taking the yellow.
No, I'm pink. I'm slow and
All right.
steady. I'm the torch.
Exactly, and 90% of the audience picks the pink, and our brains gravitate towards that pink line because it does give you the nice balance of that risk return that I think we all think about when we consider investment choices, right? We want to balance some risk, but we want to get some return as well. So that pink line really scratches that itch, I think, for a lot of us of balancing that risk and return. If we go to the next slide, these were actually 4 real life investments. You can see the red line is Pfizer, which has done extremely well as an individual stock. The green was actually the U.S. stock market. U.S. Treasury bills is the yellow that nobody ever picks. And the pink that 90% of people pick was what was known as Fairfield Century. And I'm not sure anybody knows what Fairfield Century is, but it was the Bernie Madoff feeder fund. So if you remember Bernie, he ran the biggest Ponzi scheme in investing fraud history. So that was his fund, what was known as Fairfield Century. And that was the case. It was too good to be true. But this is just an example, granted, in an extreme example of what we're talking about with the psychology of investing, understanding how our brains are wired, how we're programmed as humans, and some of the pitfalls that we can fall into when we think about investing, when we think about money, right? That pink choice might have seemed like a good choice, but it was too good to be true at that point. So an extreme example of what we'll get after the rest of the way, which is just understanding some of those pitfalls that are out there.
And now we understand why 12 Points has a chief investment officer who's not Dave.
Exactly. Stepping through, we'll go through the Isaac Newton slide and story just for the sake of time. Go to the next slide. And here's a quote from one of the better investors, Warren Buffett. We don't have to be smarter than the rest. And he was talking about, what makes a great investor. We just have to be more disciplined than the rest. And I think that always is true. I think folks always think the smartest person in the room is a great investor. That's just not the case. The person that's the most disciplined person is actually the best investor. That's what Warren is touching on. And then we'll get after a lot of this discipline throughout the rest of the presentation. Really, I think about it, how do we build that discipline muscle going forward? So what we'll touch on the rest of the way, we'll talk about 2 of the main emotions where we see most of the mistakes. On one end of the spectrum, you have envy. Envy can be a really powerful emotion. And then on the other side or the other end of the spectrum is loss. And loss is probably one of the most studied emotions out there when it comes to investing. And then third and finally, the last section, we'll talk about some best practices we've seen from investors and from advisors across the country on how to build up that discipline muscle more directly. So
Mark,
let's talk a little.
Sorry, we may have to update that slide from envy. I believe they call it FOMO now these days.
Yeah, I was going to say it is a lot of FOMO, right? Which millennials know, which is that fear of missing out. And if you step through to the next slide, first off, I have to apologize. This is the best I could do for a picture of envy, is a $20 bill with a fishing hook through it. That's the extent of the BlackRock visual library, I think. But envy and regret and that FOMO that Dave mentioned is so critical here as an emotion. Think about the way we make decisions. Think about all the decisions we make. Think about how many times you make a decision, the outcome is okay, but you think about how it could have been even better, right? If you would have done things just a little bit differently, the outcome would have been even better. That's such a natural thought process that we all have. That's envy and regret. And the challenge there is it can be damaging to your decision making going forward if you have too much envy and regret. And we'll talk about that in a moment. But next slide is a great example of a study, and this has nothing to do with the markets or the economy or investing in general. but it has everything to do with the Olympics. And they do this study every time the Olympics rolls around, and they look at the happiness of medal winners on the podium. Believe it or not, somebody actually studies that too, by the way. But it's a fascinating behavioral study that looks at the fact that the bronze medal winner is 1.5 times as happy as the silver medalist. Of course, the gold medal winner is the happiest. We throw them off the slide. It's not that interesting. But think about the bronze medal perspective for a moment. They're just happy to be there, right? Think about the difference between third and fourth place in the Olympics. Not sure what you get for fourth place, but I know it's not a medal, or being on the podium or getting your country's flag raised in your honor. So there's an enormous drop off between third and fourth place in the Olympics. And you see that in the happiness of the medal winner on the podium. They're just happy to be there. Versus the silver medalists. Think about that silver medalist for a moment. They're riddled with that envy and regret. They're thinking about what they could have done differently to make up those fraction of inches, those fraction of seconds. That's the difference in some of those events. They're riddled with that envy and regret, and it really eats into their happiness on that podium. So a great example of what we all naturally feel as we make decisions, as we deal with outcomes. And it really applies to investing. Think about a diversified portfolio on the next slide. A diversified portfolio is the exact example of being a silver medalist, where it doesn't always feel good. And in this slide, we've got a lot of numbers, and we got a lot of emojis there. I try to use my fancy emojis to capture the emotions. But look at the diversified portfolio. This is a 60% stock, 40% bond portfolio, that diversified portfolio. So everybody will have something different based on where you're at in your investing life cycle and where your risk tolerance is. But look at the dynamic of this diversified portfolio versus the U.S. stock market, or what's known as the S&P 500, which is the 500 largest stocks here in the U.S. Look at the challenge here. You still lose money in a difficult market. That never feels good. So even that diversified mix, look at 2008, kind of right in the middle. Even that diversified portfolio that had stocks and bonds in different categories still lost 26%. That never feels good. Quarter of your assets gone in a calendar year. That doesn't feel good to anyone. Then on the other side, look at that 2009 to 2019 period, right? So just one below that, 11 years from 2009 to 2019, U.S. stocks were up 350%, right? That's glorious. That should feel glorious coming out of that. But look at the diversified portfolio. You're only up 219%. So you left 120% on the table by diversifying your assets across the board, right? Not putting all your eggs in one investing basket. And you look at this over time, and these are real life returns. And you can see the same dynamics the last couple of years. Lose money, trail, lose money, trail. It just doesn't feel like you're getting ahead with this diversified mix. You feel like that silver medalist, right? Too often. You have regret and envy, right? You regret investing when the market's down, and you have envy on the upside when you're not up as much as the overall stock market. But look at the very bottom there in the gray. If we add up this 20-plus year stretch, the diversified portfolio actually ends up ahead, actually wins, and does so with a heck of a lot less risk. We don't even put the risk on this chart other than the drawdown in those difficult markets. But you get the idea. This is what we call at BlackRock winning more by losing less. Sounds a little bit like a riddle. Winning more by losing less. You don't need all the upside of what the bull market brings, right? The good markets, just get a chunk of it. What's equally as important, if not more, is limiting the losses in the tough markets like 2008 or last year, right? So get a chunk of the upside, minimize that downside. That's how you win more by losing less. But it's emotionally challenging as you go through it, because think about how unsatisfying this is, where you still lose money, trail, lose money, trail. I think that emotional dynamic is important to understand with that diversified portfolio, that silver medalist feeling, that envy and regret that's so natural to all of us. I think that's part of that discipline process that we all need to understand to become better investors. Moving ahead. Yeah, go ahead, Dave.
I was just saying that's a fantastic slide. Thank you, Mark. It is
we do
psychology.
Yeah, no, absolutely. And we have this one as a one pager as well. We can skip through the lottery slide. We'll talk about that another day, and the next slide as well. because I think it's really important to understand the math behind winning more by losing less, right? The cute little saying, winning more by losing less, but it really is about the math behind it. And everybody probably wasn't expecting a math quiz on a Thursday morning, right? When they dialed in, but look at the investing math here. And this is why that previous chart works, by the way, is if you start with $1, you lose half, you lose 50 cents, you're down to 50 cents. So you've got to be up 100% just to get back to break even. So think about the combination of that math, down 50, up 100. That's what gets you just back to break even, regardless of whether you start with $1 or you start with $1 million, the percentages are the same. But look at the bottom of the chart, the bars in the bottom. Look at 10% on the left side there. If you're only down 10%, you only have to be up 11%, or for the math geeks out there, 11.11111 to get back to break even. Look at what happens the further you step to the right of that chart. All of a sudden, you've got to be up a lot more just to get back to break even. Look at that minus 50 up 100. Look at one step to the right. Just an additional 10% loss from minus 50 to minus 60. Now you've got to be up 150% at minus 60 just to get back to break even. This is what we want to avoid in investing. You move too far to the right on this slide and you just impair your portfolio because you're going to have to be up too much to get back to break even. That's why it's so important not to chase those hot trends or those fads that are out there, right? We all see them from time to time, right? Those get rich quick schemes, because they have a lot of this downside risk that's inherent there. And I think a lot of folks lose sight that we probably all knew this, right, from math classes at a certain point, but it's easy to forget this simple investing math, especially when we get caught up in the emotions, right, of envy and regret. So for us, just a really valuable lesson. Stepping through to the next slide, we'll switch gears to the loss emotion. And the loss emotion is probably one of the most studied emotions in the psychology of investing field. They've actually found that most of the studies all agree that for most people, losses feel twice as bad as gains feel good. Think about that for a moment. Losses feel twice as bad as gains feel good. I think we can all probably relate to that at some point in our lives, where, boy, that loss hurt a lot more than had we been up. Felt on the good side. So for us, it can create all kinds of irrational behaviors because that loss emotion is so powerful in that way. And one of the things that it does is that first thing there is that it creates a tendency towards action. We want to do something if we're experiencing losses and something's broke. Think about if the car breaks down. Knock on wood, I don't want to jinx my car, but if the car breaks down, you've got to take it into the shop. You've got to take action to get it fixed. It's not going to fix itself, and Lord knows I'm not going to fix it. So I've got to take it in to get it fixed. And that oftentimes in our lives, that's a good action. But the next slide shows another non-investing example of this tendency towards action that is out there. And this is a famous study. I don't know if anybody's a soccer or football fan. I guess they call it in football in Europe. And we're just coming off the Women's World Cup, right, in soccer. And they've done this study to illustrate this tendency towards action, and it looks at the penalty kick. Does everybody know what the penalty kick is? It's just the goalie against the kicker one-on-one. And this is actually how the U.S. women lost. They lost in a penalty kick to try that decided a tie match, right? They were tied at 1. They went to penalty kicks, which is just the goalie against the kicker one-on-one. And in Europe, they've done a lot of studies. What should the goalie do in this situation? Because it's really, really challenging for the goalie, because the goal in soccer is huge, right? It's 14 yards wide and the kicker's only about 12 yards away. So especially for these professional soccer players, they can kick the ball past the goalie before the goalie can even move. So a well-struck ball, they have no chance on. So what should the goalie do? And the studies show the goalie should sit in the middle and wait for an improperly struck ball. That's their best shot at stopping the ball. And all the goalies know this study. They all seen it. They've all been told about it. But look at the box. 94% of the time, and you can watch it the next time there's a penalty kick, and it's classic. The goalie will decide a direction to jump before the ball's struck in anticipation where it's going to try to stop it, because they can't help themselves in this highly pressurized situation where they don't want to let their teammates down. They don't want to let their country down. It looked like they did nothing to try to stop the ball. So they will dive left or right like clockwork. It's amazing. And the studies actually show the best place for the kicker to kick the ball is right at the goalie's head where the goalie starts. You'll score 80% of the time if you kick it right at their head, because the goalie's not going to be there. So a great example of this tendency towards action that we have is that when we're under pressure, when things aren't working or broken, we want to do something. We don't want to just sit there and take our lumps. And that happens all the time in the investing world. And you see that on the next slide, just a great classic example. I think every financial firm actually has to have this slide by law. I think every firm has it, but it shows what happens if you miss the best days in stock market history. So this is the last 20 years, and you can see 100,000 actually grows to 647,000, which actually is not too shabby considering you got some big bear markets in there. So 100,000 goes to 647,000 in 20 years. But look at what happens if you just miss the best 5 days. All of a sudden that 647 is now 409, right? That's not a little bit, that's a lot of bit difference. Miss the best 10 days, look what happens on the far right. If you miss the best 25 days, you're almost back to break even. And there's about 250 days the stock market's open in a year. So this is 5,000 days over 20 years where you're earning returns in the market. If you just miss the best handful of those days, it really has a huge impact. And think about what happens here emotionally to us is we have a bad day in the market. For example, back in March in 2020, think back to when the pandemic and the shutdowns were really taking hold. We had 3 of the worst days in stock market history. We actually had number 2 and 3. Only October of 1987 was worse. But we had number 2 and 3 of the top 10 in March of 2020. But what folks don't realize is we also had 5 of the best days in stock market history in March and April of 2020. These best and worst days in stock market history sit right on top of each other. So if you do something, get your portfolio out of the market, change it, and get more conservative because you can't take the losses, you might miss some of the best days on the other side. It's amazing. This is probably the biggest mistake we see even good investors make from time to time, because the loss emotion overwhelms them, generates that tendency towards action. They do something with their portfolio, get out of the market, they miss one of these best days. I think it's important to really connect the dots here and understand, hey, this is driven by that loss emotion. They feel twice as bad as gains feel good. That tendency towards action kicks in. You're going to try to time the market. You need to fight that natural temptation that we all have. Again, one of probably the biggest mistakes we see, and it happened a ton back in March and April of 2020. Folks got out of the market because there was so much fear and uncertainty, but they missed the best days in March and April of 2020 on the other side. So for us, one of the biggest challenges we see, again, just amazing how often this pops up when the market gets volatile. Stepping ahead, we'll step through the next couple slides here just to, again, for the sake of time, and just end up with this last section, building in some of that discipline more directly. Just some of the best case studies we've seen from advisors, from investors across the country. First thing is to lean on Dave and team at 12 points. They can be that emotional check and balance for you. Don't underestimate that. I don't think we talk about this enough as an industry, is how much of this emotional check and balance we all need. I can tell you, even the best investors at BlackRock, some of the portfolio managers we have, actually have a behavioral coach within our risk group. So even professional investors can benefit from having that check and balance, because it's going to end up meaning a better outcome, better performance over time if you can keep those emotions in check. And within that, on the next slide, we just look at, this is kind of an emotional roller coaster, but it's meant to represent the market. And what we've heard from some of the teams across the country is that you need to have a bear market plan. So what are you going to do if the stock market's down 30, 40% next quarter or next year, whatever the time period is? Are you going to maybe sell stocks and buy more, or excuse me, sell bonds, buy more stocks at cheaper prices? Or maybe you take some tax losses, make it the accountant happy, right? And reposition the portfolio for where the market's at. Or maybe it's increasing contributions. I know I do that. When the market was down last year, I increased my 401k, increased my 529 savings account, again, taking advantage of higher prices. All those are good tactics, and there's probably some more out there. But what we heard from investors and advisors across the country is, if you talk about this deliberately at each point of where the market's at, don't just wait for it to happen, right? That's the old trap, is everybody waits to talk about the plan for when you're actually in the heat of the storm and the markets, your March of 2020. Think about how tough it would have been in March of 2020 to rebalance and buy more stocks at that point in time when the market was down almost 35%. Very difficult for anyone to do that. But what we heard from investors, and I'm sure some of you are doing this already with your advisor and Dave, is talk about what are you going to do if the market's down, even after a great year, right? This has been a good year, but still talk about, hey, if the market's down, here's what we're going to do. And it was amazing how often we heard from investors that they said it's a great way to neutralize those emotions, because you can reflect on the conversation and say, oh yeah, I had no problem talking about the bear market plan when the market's up 20%, right, this year, because I don't have that loss emotion that's revved up within me. And they just said it's such a better way to execute, or you increase your likelihood of doing the right thing in that bear market because you've talked about it at each step along that emotional roller coaster. So really a simple thing that doesn't cost you anything to do, and you're certainly doing it to some degree, but especially if you're somebody who is prone to that loss emotion getting revved up, just talk about it with Dave and team. What are you going to do if the market's down over the next period? Let's be square on that, because that'll allow us to better execute if we do run into that scenario. So simple, but important idea to neutralize those emotions.
Yeah, Mark, if I can just steal one line from you, you've talked a couple times about Warren Buffett, and that's a great example for Mr. Buffett, talking about, important to be greedy when others are fearful and fearful when others are greedy. It's hard to separate yourself, but if you plan ahead, you have that opportunity to know we are going to be greedy when others are fearful. And when the market's riding high, we are going to be a little bit fearful, and we're going to take some money off the table as opposed to experiencing that FOMO. So again, Warren Buffett, a great guide to where we're going.
Yeah, and, another great quote I heard recently is, something isn't truly cheap, right, and truly a good value unless you have a little bit of discomfort, right? So just understand that emotions. And one of the last things here, and this is probably one of the biggest things in my 30 plus years, is turn off or at least turn down. I used to say turn off the news. The news is so polarized today. It's such an enemy of our investor discipline. It's amazing how many calls we get when you get a really really volatile period in the market. Even again, good investors will call and say, hey, I can't take it anymore. I read this article. I saw this on the news. Get me out. And it's amazing how often it happens. And this is known as the forecasting folly, or the expert fallacy in the behavioral world, where we see an expert on TV making a prediction and we let that get to our emotions, right? We think that's going to come true. But it's important to understand that Dave and 12 Points, and certainly BlackRock, we have a pretty good idea what the stock market's going to do over the next 5 to 10, 15 years. Bond market as well, just based on where interest rates are at, where valuations are at. We won't get it exactly, but we'll get it pretty close based on what history tells us to. But it doesn't mean we can make predictions in the short term. Over the next 6, 9 months, 12 months, very difficult to get those predictions right. And this chart actually looks at a study that we did with the Federal Reserve that looks at how often Wall Street experts get the direction of interest rates right. So think about interest rates have gone up the last couple of years, but interest rates never stay the same. They either go up or down. They never stay the same. So the coin has a 50% chance of getting right? Flip the coin, heads or tails, right? Whether it's going to go up or down. Wall Street experts get it right about 47% of the time over the last 30 years, just the direction of interest rates. But understand, longer term, we still have a good idea, but don't give in to some of those news sources, some of those short-term predictions. They're just an enemy to our investor discipline, and it's just such amazing how often this happens. And one of my favorite philosophers on the bottom there, catcher, New York Yankees, Yogi Berra, Yeah, he said famously, it's tough to make predictions, especially about the future. So don't let some of those short-term predictions derail your investment plan. Again, it's amazing how often this happens today versus 30 years ago.
And if I
So
can
I
add one,
think,
oh, sorry, Mark, if I can add one more in while we're picking on financial TV, and hopefully this doesn't go against BlackRock's philosophies here, but you know, my favorite memory is Jim Cramer in the middle of the 2008 crisis declared that the market was uninvestable in early 2009. And then in 2011, he was raving about how great the returns had been. And I said, well, he said, you couldn't invest for 5 years in this market. It was uninvestable. And I said, well, sorry, Jim, I still got 3 more years before I can get back in according to your previous prediction. So I guess I'm still out. I
yeah,
don't.
exactly. And I love that story, David. You know, one of the ones I use, and I'm certainly guilty of watching these financial shows all day, every day, but CNBC, we'll pick on them again. Think about what the names of their shows, and one of these are the Jim Cramer show in the afternoon, but the 2 names of their shows in the afternoon are Mad Money and Fast Money. Mad Money and that's the names of their shows. So think about what they're trying to do. They're not trying to give you good investing advice. They're going to get rich quick schemes there that are not durable and long lasting over time. So understand that those folks are an enemy to your investor long-term investing discipline. Mad Money and Fast Money blows my mind that they don't even recognize that how unhealthy that is for everybody's investing lifestyle. But I think that does it for our charts. But hopefully that was helpful. Think of where we started, just how important this topic is. That foundation of any good, successful investment plan is your investor behavior, your ability to stick with that investment plan, and it's all because of some of those emotions that are natural, right? That envy and regret and FOMO on one side, right? That silver medalist feeling that makes you lose that winning more by losing less, right? You don't realize how good that can be over time. So important to stick with that plan, be diversified. Don't put all your investment eggs in one basket, right? We want to get a chunk of the upside, but minimize the downside. That's how you build wealth over time. Take advantage of that sweet spot in the math where we talked about it, where you stay off those big losses. That's critical. And then that loss emotion on the other side, right? Remember that loss emotion is powerful, very powerful, twice as bad. It feels twice as bad as gains feel good. It'll drive you to want to do some kind of action, but make sure it's a positive action, not getting out of the market, right? Because those best and worst days sit right on top of each other. You don't want to miss those worst days on the other side. That's how you impair your wealth over time. You need to avoid that. And finally, right, lean on Dave and team, the folks at 12 points. They can be that emotional check and balance for you. Critical, right? Have that plan in place. Talk about that bear market plan, especially if that loss emotion is something that hits near and dear. And turn down those news sources as much as possible. I used to say turn them off, and I realized nobody turns them off. But maybe filter them through the idea that, hey, I don't want these ideas or forecasts or some of these stories to impact my investing outlook. So all those things we think will help you become a better, more disciplined investor. And the last slide on the next page is why, right? Keep your emotions with the friends, the families, the loved ones. That's where your emotions belong. Your emotions don't belong in your investment planning and thinking. I think we can all relate to that here over the last handful of years. I think we've all lived that to some degree. That's where emotions belong. So I'll stop there, Dave. See if you have any other thoughts or comments or anything else you want me to fill in.
No, I think you nailed it. Really, Mark, that was fantastic. You nailed it so much, nobody even asked any questions. I'm shocked. So I guess your message was very clear. So with that, I will, unless anyone types anything in the box in the next minute here, I'm just going to say, Mark, 30 years of experience, clear, and the BlackRock team behind you clearly comes through because everyone got what they wanted out of the webinar. So fantastic. Thank you so very much. We appreciate it. If anyone does have questions off that, if they didn't get them into the chat, the computer, we got one that says great insights and thank you. So Mark, there you go. We got another thanks. So people are happy. We love rave reviews. But if you do have questions, you didn't get a chance to type it into the box, your computer was being a spaz, whatever it was, feel free to reach out to us here at 12 Points. So I'm Dave at 12 Points, or reach out to your direct advisor and we'll be happy to help you out. And if it requires Mark's expertise, we'll get in touch with him. we hope you enjoyed this today, and we look forward to having you join us in our September webinar. Thank you, everyone.
Thanks,
and
everybody.
thanks,
Thanks,
Mark.
Dave.